Greetings from Columbia Business School, Executive Education. My name is Scott Gardner, and I'm very happy to be here today with Professor Angela Lee for today's webinar, An Introduction to Venture Capital Lessons from 15,000 Pitches. Before I introduce Angela, I'd like to just go over a few quick logistics. A recording of this webinar will be made available to you. If you'd like to tweet about this webinar, please do so at #CBSExecEd. And most importantly, please submit those questions to the Q&A box, and we'll get to as many of those in the last 10 minutes. It's my pleasure to introduce Professor Angela Lee. She is the Professor of Practice and Chief Innovation Officer at Columbia Business School, where she teaches top-rated courses in venture capital and leadership. She has launched 4 startups in her career and is also the founder of the investing network 37 Angels. Has spoken at the White House and is regularly invited to advise decision makers at the highest levels, including Prime Minister Trudeau. She was recognized by Inc. magazine as one of 17 inspiring women to watch in 2017, by Crain's as a notable woman in tech in 2019, and just this last week, Angela received the Dean's Award for teaching excellence right here at Columbia Business School. Congratulations, Angela. Great to be with you today. I am going to rejoin you in the last 10 minutes, and I will mute my screen and mute my sound and leave it over to you.
Hello, everybody. It's fantastic to see so many people engaged and listening in about this topic. What I was planning on doing is covering 3 quick questions in today's webinar. The first is, what is it that investors look for in diligence? A fun fact for you all is that Shark Tank is the most watched family show right now in the US. And so all of us are tuning in and watching these, but you know, what is Mark Cuban really thinking? What is Barbara Corcoran really thinking as they're making these decisions? So I want to give you a sneak peek on what it is that investors look for in diligence. The second question is, some of you might be asking yourself, should I participate in this asset class, either as an angel investor or participating in a fund? What should I be asking myself before I make the leap? And then lastly, I wanted to share some resources that existed for everybody to follow up on, because I can't help myself but to give you all a little bit of homework following the webinar. So in terms of what investors look for in diligence, it breaks out into a nice alliterative 4 Ps. So the first is people, then problem, then progress, then price. So you'll notice it is very much in that sequence, which is, for early stage investing in particular, what matters the most is the team behind the business. It's not the problem, it's not the valuation of the startup, it really is who is building the startup. Do they have that domain expertise? And then and only then do we think about the problems they're solving, the competitive landscape, how much traction they have, and what that valuation is. So in terms of people, what we're really looking for is relevant domain expertise. So I will talk about a startup that I personally invested in 2013. Board Vitals makes medical board exam questions for doctors who are practicing for their medical boards. And they got acquired by Ascend Learning in 2016. And what they were doing is, for those of us who took the GMAT or the SATs or the LSAT, whatever the case may be, we all remember taking lots and lots of practice tests to hopefully get a higher score. That's what Board Vitals does. Now, the founding team behind this is Andrea. She is a board certified cardiologist. She is very, very well regarded in the ecosystem. She has a deep Rolodex specifically in the medical space, and she was going to open up a lot of doors for this company. And then we had Dan, who comes from a background in education technology and really understands how to craft questions well. He also was a full stack tech developer, so understood the technology needed to build the platform. And on top of that, is a business school grad, and so has the business chops to really understand how to think about the business model and the revenue model for the startup. That is the team that I want building this company. I don't see anything major missing, and that is the team that I want to back in terms of this startup. Now, we did not spend a lot of time diligencing the technical expertise of this team. Yes, Dan is a full stack tech developer, but we didn't spend a ton of time really thinking about what are the technical chops of this team. Why is that? The reason why is because technology is not the differentiator of this company. Again, think back to when we were practicing for the SATs, the MCATs, the GMATs, whatever the case may be. For some of us, it was on pen and paper, but for other of us, it was on some sort of web-based platform. We were taking practice tests. And I'm sure none of us remember what that platform looks like. What do we care about? We care about the questions really being relevant to help us get a higher score. And that's what this team was really, really good at based on their background. That was the core differentiator of this startup. And that's what we really wanted them to focus on. Contrast that with Maz Digital, which is another company that we invested in. If you have read a magazine on a tablet, they're the technology that enables that. You better believe that we diligence the heck out of this technology team, because technology is the differentiator for this startup. So we are really looking to understand as an investor, what is the real core problem that they're solving, and do they have the right team around that? And I share this because I think a mistake that new investors sometimes make, and founders, is they try to fill out the C-suite. They're like, do I have a CEO, a CTO, a CMO, a COO? Yes, that's important, but what's more important is what's the core of the problem that you're solving, and do you have the best people to solve that particular problem? One way that we test founders having the right team is to ask the question, when and who is the next person that you're hiring? And what we want is, we want to see, are they self-aware? Do they know what the founding team is great at, but what the founding team is missing, and how they're going to sequence that hiring? So I'll give you an example of a company we looked at recently. It's a fintech company that's really grounded in artificial intelligence. The massively simplistic way to describe them is FICO score for businesses. It's massively underselling what they do. Now, this was a founder, was a data scientist, so because data scientist was very much at the core of this company, which is great. And he had a team of 7 data scientists working for him. And I asked, who's going to be your 8th employee? And his response was, I'm going to hire a data architect. And I would argue the correct response was, you really should be hiring a salesperson. Because yes, they can build the most amazing product, but if they don't have customers buying it, then it doesn't matter if they have the most amazing algorithm underneath their technology. And so this was an example where we didn't think they were self-aware of what was needed in the next hire. So we spent a lot of time thinking, who's your next hire? What's really missing from your team? So those are kind of the easier things to diligence, right? Do they have relevant domain expertise? Do they have a complementary team that's self-aware? What's harder to diligence is this magical it factor, right? As I'm sure a lot of you know, typically when a company is coming to us, we have seen that idea before. And so I need to look that founder team in the eye, and I need to believe you are going to beat the other 10 founders who've been in my office over the last year pitching this exact same idea. So what are those more kind of intangible things that we look for? So one is successful serial entrepreneur. If a founder has sold a company previously for a nice exit, we are much more likely to back that company because they know how to fundraise, they know how to sell, they know the mechanics of what it takes to get a company ready for acquisition. Obviously, we're going to back that company more likely. Do they have a good working dynamic? And that is both with the investor, but also with each other. So with the investor, were they defensive when we asked them questions? Were they responsive when we asked for more information? With each other, was there kind of a balanced amount of talk time? Did you have one founder that spoke 90% of the time and then cut off all the other co-founders? Was one person rolling their eyes? Did you kind of sense some tension? So you want there to be a good working dynamic because they're going to be working together for a long time. They're going to be working with you for a long time. You want there to be a good working dynamic. Are they bringing the team back together, right? So we'll always ask, how long have you all worked together? And a great answer is, we started a company before, we sold it to Google, and this is now our 3rd startup together, right? Versus, I met this person last week at a meetup, right? That's a less good answer. So ideally, they've worked with this person before. They know what it means to kind of argue over maybe technical features. They know what it means to work until 2 in the morning. Some nights they've really worked together before. Coachable but discerning is something else we look for. So we're looking for people who are taking in a bunch of input with a really open mind. So they're listening to their customers, they're listening to their investors, they're listening to their board members, they're taking in all of this input with a very open mind, but they're discerning in what they then implement. So what we don't want is a founder who every time they hear customer feedback, they add a feature to their product. What we want them to do is instead take in all this feedback with an open mind, but be discerning on what they change and tweak as a result. Data-driven learner. There is this fallacy right now that founders are visionaries and able to predict the future. No, really good founders are running a bunch of fast failing experiments, looking at the data that emerges from those experiments and then pivoting as a result. So we love founders who know their data really well and have made data-backed decisions on how to pivot and make decisions in their company. And then the last two are a little bit more kind of straightforward. We're obviously looking for some grit and hustle, but also empathy. And this is especially true around customer empathy. So two sectors that we look a lot in are education technology and healthcare technology. In both of these cases, if I were to ask you, who is the customer? It's not a simple answer, right? So if you think about ed tech, who's the customer? Is it the parent? Is it the student? Is it the teacher? Is it the principal? Is it the superintendent? And so when I say customer empathy, I'm looking for a founder who understands what is my value prop to every single person in that value chain. Think about health tech. Who's my customer? Is it the patient? Is it the doctor? Is it the nurse practitioner? Is it the insurance company? Is it the hospital network? Whatever the case may be. And so deep customer empathy really enables them to understand their customer better and build a better product as a result. In terms of problem and price, what we're looking for are really, really large markets, and we're looking for founders who understand their relevant market size. So I'm actually going to skip over this example. I'm going to go to this one. We looked at a startup that makes personality assessments for employers, or I should say employees. Right now, innovation and creativity is a very hot topic, so everybody wants to hire people who are innovative and creative. So they basically made a personality assessment test that you could give a prospective hire, and it would tell you on a scale of 1 to 10 how innovative, how creative they were. What's the market size for that? This is what they came back with. They said, the Global Innovation 1000 spent $680 billion, and look at all these conferences that are happening in innovation. This tells me nothing about relevant market size. So I'm looking for a founder who's really able to say, what are employers spending on personality assessments? Is that even a thing? What percentage of people even care about innovation as a key metric they're looking for? And to really start to cut down that market to say, what's the relevant market size that you're playing with? So we're looking for founders who truly, truly understand their market. From a progress perspective, a question I get asked all the time is, how many customers, how much revenue do I need to have before I can approach a venture capital firm? And that's not the right question to be asking. The right question to be asking is, do I have a repeatable progress? Do I have a repeatable customer acquisition engine that I've built? So by the time a founder is pitching an angel investor or a venture capitalist, they should be able to fill in this slide. They should be able to say, I tried a bunch of different marketing channels. You know what works best for us? Direct email works the best for us. I know that when I email 10,000 people, that 1,000 people open the email, 200 people click on the shiny green button, and I get 10 customers as a result of emailing 10,000 people. I know that subject line A works better than subject line B. And most importantly, I'm able to calculate two magical numbers, which is CAC and CLV. CAC is customer acquisition cost, and CLV is customer lifetime value. You cannot approach a professional investor without knowing these two numbers, which is, how much does it cost you to acquire that one customer? I had to pay for an email marketing list. I had to pay for a copywriter. I had to pay for MailChimp. As a result, each of those 10 customers cost me $30 to acquire. And I know my customer lifetime value, which is typically a customer spends $100 with me before they leave and they churn and they get bored. And you'll notice here that the ratio is about 3 to 1. At a bare minimum, as an investor, we need your CLV to CAC ratio to be 3 to 1. We need a 3 to 1 ratio. 4 to 1 is better, 5 to 1 is better than that, but that floor, the minimum we're looking for, is a 3 to 1. I'm not going to talk about price and valuation today, and the reason why is because it's a very in-depth conversation that I teach in my class, which is all about how do you value startups. But the punchline is that it is very gut-driven, it is very market-driven, and yes, there are mathematical ways to value a startup, but a lot of it is gut-driven, and I'm happy to answer questions about that during the Q&A. Okay, some of you might be thinking, I might want to invest in this asset class. What are some things you want to ask yourself before you do so? The first thing is to figure out, are you comfortable with the risks? So a lot of the times when people think about venture investing, angel investing, they think about all of the fun stuff, right? They think about that I'm going to learn a lot. I'll get to mentor. I'll get to meet a really cool network of people, but it's important to understand the risks. I'm going to talk about financial risks in a minute. It's really important that these are highly illiquid investments. So typically, you are going to be investing in this company for 5 to 10 years. Right now, if you invest in a seed stage company, the average exit timeline is 8 years. And so you're in this company for a really, really long time. It's also fairly undiversified. In major startup cities right now, a founder is not going to take less than a $25,000 check. So it's very hard to invest a little bit in a lot of companies. It's a fairly undiversified portfolio that you walk away with. You're not going to have control. You're going to be a minority investor for the most part, so you're not going to have control, even if you get some voting rights. And it's really emotional, right? It's very different than investing in the public markets. You get to know the founders really, really well. In terms of that financial risk, what can you expect? If you write 10 checks, the expectation is that you're going to lose all of your money in about half of them. You're going to hit some singles and doubles in some remaining ones, and then you're going to make all of your returns from that 10th investment. You're going to make 10x, 20x, maybe 50x from that 10th investment. So it's incredibly irregular returns. And again, it takes a long time to do this. The money's going to be tied up for 5 to 10 years. I've mentioned VCs and angels a couple times just to make sure we all know the difference between those two terms. A venture capital general partner is managing money on behalf of their limited partners, just like in a mutual fund, whereas angel investors are making investment decisions for themselves based off of their own portfolio. That's the primary difference between VCs and angels. And in terms of fees, venture capital GPs are taking usually 2% in fees and 20% in carry, and limited partners then get 80% of the fund returns. Usually in an angel network, you are charging an annual membership fee, and then the angels get 100% of the returns as a result. It's important to know how much control you want to have. So if you're thinking about participating in this asset class, you can be a solo angel, which means you have all the control in the world. You are out there sourcing deal flow on your own. You are out there talking to founders. You're out there diligencing on your own, and you're making your own independent investments. Or you can join an angel network where you're joining a group of people. They're probably curating some deal flow for you, and you have some autonomy over what you invest in. Or you can create an angel fund with 10 of your friends. You each put in $100,000. You form a $1 million fund, and you can invest that $1 million together. The good news is you get diversification. The bad news is you now have to make those decisions with the other 9 people in that mini angel fund. Or you can say, I want no control. I'm going to take my own money and I'm going to give it to a general partner of a fund, and they're going to manage it on my behalf. There's no right or wrong answer within the spectrum, but know how much control you feel comfortable with, which is very correlated to how much time you have to dedicate. So just to give you a sense, so 37 Angels, every year we look at 2,500 companies. We introduce 40 to our angels and we invest in 10. So to be a solo angel, it takes a lot of time to look at all of those companies. I promised homework and resources, and so I have a little bit for you. So for those of you who want to engage with the community, I really recommend that you sign up for some sort of local community-based newsletter where you are committing to yourself that once a month or once a week, I'm going to go to one startup event. I'm going to hear pitches. I'm going to maybe learn about a certain industry, and I'm really going to start to network with the ecosystem because it is such an ecosystem that requires networking. I really encourage you to learn about the ecosystem. Columbia Business School has an exec ed course that I teach on venture capital. There are a ton of blogs that you can read. I've listed some here. Brad Feld, Fred Wilson's blog. For those of you who are really data hungry and you want to see lots of charts and infographics, PitchBook, Halo Report, and CB Insights are really, really data-rich resources to get a sense of the market. Lots of podcasts that exist. I've highlighted 2, Masters of Scale and Full Ratchet. And then I mentioned networking. So you can join an angel network, you can join an accelerator to get a sense of what hubs exist out there already that are connecting investors and founders, and find people to do this with, right? Find people to go to events with, find subject matter experts to learn from, and really go at it together. So with that, I'm going to invite Scott back in to take some questions. I think what I'll do is I will leave this slide up while we do questions in case people want to take notes.
Great. Thank you very much, Angela. And your perfect timing. We've got 10 minutes for questions and a lot have come in. I've got my command center right here. So let's get started, shall we?
Of course.
Great. So the first question that came in is a good general one just to kick it off. It's, what is the best advice for someone wanting to make a career switch to venture capital investing?
So a lot of it's on this page, right, which is engaging with the community, networking, learning as much as you can. But then a very specific ask I would have of you is if you really want to get into venture capital, if you're serious about it, I would write an investment thesis. So an investment thesis is a 10-page PowerPoint deck, which says, what is my perspective on a specific industry? And the question I like to have people ask is, if I had a $50 million fund to invest, where would I invest it? And your response is, I would invest it at the intersection of augmented reality and education technology. You know, here are some trends in ed tech that are happening right now that I think makes this a really exciting space to invest in. Here are some recent technology developments. Here are 3 startups that I would invest in that are doing really cool things in this space, because VCs are looking for you to have a perspective. And so they want to get a sense of not just your interest in the space, but do you have a perspective on a particular space? And that becomes a great prep for an interview, becomes something you can send to a venture capital firm to show, hey, look at how much thinking I've done on an industry, even better if it's an industry that they're invested in. So do all of these things, plus take some time and really write an investment thesis and immerse yourself in an industry. For those of you who want research on that, Bessemer Atlas has some really great resources for you. Bessemer is a very well-known venture capital fund, and they have something called Bessemer Atlas, where they have sample investment theses that you can look at.
Great, thank you. This one came in from Bimbala. He says, while there is merit in teams who have worked together on past engagements, could there perhaps be a risk of groupthink?
Yes, there definitely is a risk of groupthink. That said, I would argue that a team that's worked together before, that's fought together before, that's successfully sold a company before, that outweighs the risk of groupthink. In terms of groupthink, what we look for is diversity, right? So that is gender diversity on a team, that is racial diversity, that is age diversity, it's diversity of background. I always joke, you know, that I don't like to see 3 founders that are like all former lacrosse players, that are all went to Duke, that all, you know, are ex-lawyers, right? You want to see kind of diversity of experience as well. And so I find that minimizes the groupthink.
Great. So one of the things you talked about in here was, and I'm going to combine 2 questions because I think they are relative to people who have been, you know, leading this for a while. In other words, who've invested a while. So the first one is, do you run into this frequently where the founder doesn't know the next step? To me, it's always that nothing really happens until someone sells something. And then combined with that, have you seen overconfidence in successful serial entrepreneurs? Is that a warning sign?
I've never seen overconfidence in an entrepreneur. What are you talking about? No, of course. Yes, I definitely see hubris with former founders. And what I tend to see it happen in, the way it manifests, is they are very early for their next fundraise, yet their valuation is very, very high. And the reason why is because they can get away with it. If they're able to say, I did a $100 million exit to Amazon 2 years ago, VCs will give them money with nothing, right? And so they have the hubris because they are able to fundraise on very little. So that I've certainly seen. And then in terms of them not knowing the next step, I would say for us, we wouldn't fund that founder, right? We are, investors are looking for founders who do have a adaptable, agile roadmap for the next 18 to 24 months.
Great. You mentioned the thesis. Can you repeat that again? A few people wanted to know exactly the thesis you mentioned previously.
So the resource I mentioned was Bessemer Atlas. But what a thesis is, it's your perspective on an industry. So what do I think is the future of education technology? What are the trends? What are the technology trends? Who are the big players? What are 3 startups I would invest in today? And it's really showing somebody, this is what I think is the future of this space. And again, Bessemer Atlas, they call them roadmaps, but they have some good examples of that. If you also want to read another investment thesis, Union Square Ventures, which is probably the most well-known fund here in New York City, they also published their investment thesis, Union Square Ventures.
Union Square Ventures. Okay, great.
Yeah.
All right, that's good resources. So this question, Amritha asks, how do you evaluate, now the other side, a first-time entrepreneur with respect to the concept of looking at their track record as a serial, you do with serial entrepreneurs. Also, for a first-time entrepreneur pitching to a VC, does their sector experience and investment experience position them well?
Yeah, so I would say, first of all, most of the founders we talk to are first-time founders. Most founders are first-time founders. And the good news is statistically speaking, a first-time founder is just as likely to be successful as a previously failed founder. So don't think you have to have a bunch of, startups under your belt. But we look for kind of that page that I showed around it factor. So we're looking for hustle, we're looking for grit, we're looking for data-driven learner. And the way that you convince an investor that even though you're a first-time founder, you're going to make this happen is with data, right? So when I ask you the question, what's your customer churn? A good response is it's 8%. A better response is it's 8%. Here are the top 3 reasons why people churn. Here was the top reason last month, which we fixed with this feature. And here's what we're going to do next month to fix the next reason why people are churning, right? So it's a really data-backed answer with an actionable plan where you're learning from your customer data.
Right. Very specificity is the key word
Yeah.
there. Right? Great. So Victoria asks, do you see some sectors being able to value higher than others?
Absolutely. So the things that drive up valuation are recurring revenue. So recurring revenue is, this is why everyone loves SaaS, right? Software as a service and subscription models. So that's certainly one, recurring revenue. And another one is network effects. So a really great example of this is paperless post. When I use paperless post and I invite 30 people to a birthday party, I am marketing on your behalf as the startup. And so network effects are fantastic. And then the last thing is high switching costs. So if it's very hard for someone to leave you, that also drives up valuation. And the reason why is because those impact customer acquisition cost and they impact customer lifetime value, right? So when you have network effects, it decreases customer acquisition costs. When you have high switching cost, it increases customer lifetime value. And when you have recurring revenue, it increases customer lifetime value. So those are the big things that drive up valuation. And so industries that have that built in are going to have a higher valuation.
Great. So someone asked, how much marketing progress, such as the CAC, CLV, et cetera, should a pre-revenue startup have when meeting an angel investor?
So and I'm going to slightly get the data point wrong, but something like 80 to 90% of seed funded startups last year in 2019 had revenue. So most professional investors, VCs and angels, are investing post-revenue. It is hard as a pre-revenue company these days to get funding. Now, what's happened is what has emerged is pre-seed companies, which are basically funding you before you have revenue. But in general, these days, to get a real round raised, you do need to be post-revenue and to have that customer data that I mentioned.
Great. Okay. Anna asks, what are your thoughts on entities that make more diversified angel investing VC accessible through smaller, more syndicated participations?
Yeah, so I think it's a great thing. There are a lot of kind of I'll give a shout out to a CBS alum, which is oh my gosh, I'm forgetting the name. Plum Alley, right? So Plum Alley allows you to do this, to make smaller investments. Portfolio is another one. There are a lot of equity crowdfunding sites out there which allow you to put $1,000 into a company, like WeFunder, like Proceeder, like Circle Up. So yes, I think those are all great. There tends to be 2 potential drawbacks to those models. The first drawback is sometimes, this is more true of equity crowdfunding, you don't get to meet the founder. So with equity crowdfunding, you're going onto a website, you're maybe seeing a 2-minute video of the founder and a PowerPoint deck, and you're investing off of that. So it's, the diligence is much lighter. And the second thing is fees. So the fees to participate in equity crowdfunding are anywhere from 5 to 20%. So I think those are the 2 drawbacks. That said, I think there are great avenues to diversify.
You know, we have time for one more question. I have a good last one for you, but one of the
Great.
things I feel like I've heard you repeat, so it's like one of the most, is the collection of data. And my question to you would be, is there a place that shows, not just like you mentioned, the best way to collect data? It's not just data for data's sake, but the best way to collect it, use it, and interpret it. Is there some sort of formula that you've seen that works, or is it just being as specific as possible with that data?
Honestly, I've seen incredibly effective data capture in Google Sheets and Airtables. It's the good news is when you're talking about founder data that's, you know, a 6-month or 12-month-old company, we're not talking terabytes of data, right? We're talking thousands of rows, and you can get to a very good answer about why are customers churning using a Google spreadsheet. So I don't find that it's about sophisticated data tools for early stage companies. That's different for later stage, but we've just found it's really asking the right questions or running the right experiments and then just capturing the data as a result of it.
Wonderful. Okay, well, so one last question here from Yulia. For a first-time founder, would you recommend seeking an angel investor or a VC?
I would say both, right? sometimes people think that, angels are maybe easier to pitch to. Not always, right? You have really critical angels, and you have really easygoing VCs. So I would say that fundraise from the people who you can most easily fundraise through, and that tends to be who you are closest to in your network. So this is a very network driven business. I've said the word network a bunch of times. And so it's whoever you can get in front of in the easiest way and get a warm intro through. And so if that's a high net worth individual, that's an angel, great. But maybe somebody through the network that is a venture capitalist. So it's really about getting warm intros in, but I would say equivalent between those two.
Great. Thank you, Angela. So much great information here today. You really imparted a lot of wisdom to us. We had a lot of people attend today. We want to, on behalf of Columbia Business School, Executive Education, Professor Angela Lee, myself, thank you so much for taking the time today. We hope you're all safe and well. And Angela, thank you so much.
Thank you.